Do you find DeFi a little confusing? Well,
You're not alone.
for many, the sheer variety of services out there can feel overwhelming. But a recent report offers some much-needed clarity, shedding light on the mechanics of borrowing and lending within both CeFi and DeFi protocols. That's why today we're breaking down the key insights from that report in simple, straightforward terms, so that you can level up from a borrowing beginner to a protocol pro. My name is Guy, and you're watching the Coin Bureau. The report we'll be summarising for you today is titled, quote, "The State of Crypto Lending, Bringing Transparency to an Opaque Market." It was published in April 2025 by Galaxy Research, and we'll leave a link to the full report below if you're interested. As the name suggests, the report aims to educate people on the elusive nature of lending and borrowing services. However, we should forewarn you here, the report is worded in an incredibly complicated way, often making things difficult to understand. Here's a single, randomly selected sentence to show you what I mean. Quote, "The combination of flatter and steeper legs of the interest rate curve in conjunction with optimal utilization rates creates a self-adjusting mechanism that autonomously manages relative protocol liquidity/lender income and the capital efficiency of deposits through incentive-driven forces." Nope, me neither. To be honest, this isn't like any Galaxy report we've covered in the past. But fear not, we're going to simplify this one as we go along and give you the highlights. All we ask in return is that you punch those like and subscribe buttons and ping that notification bell while you're at it. Okay, enough talk, let's dig in. So, the report starts by explaining the differences between lending on centralized finance, or CeFi, and decentralized finance, or DeFi. Both CeFi and DeFi can be broken down into three categories. For CeFi, these are over-the-counter, or OTC transactions, prime brokerage, and on-chain private credit. Now, OTC deals are private loans arranged by a centralized entity, usually between a lender and an accredited investor. Things like interest rates, maturity period, and the loan-to-value, or LTV ratio, are agreed up front. For those wondering, the LTV ratio refers to the loan's amount relative to the value of the collateralized assets. Prime brokerages offer crypto and ETF trading with built-in financing. And meanwhile, on-chain private credit services use the blockchain as a crowdfunding tool, pooling tokenized debt funds together on-chain to then be used in off-chain deals. As for DeFi, the three categories here are lending applications, collateral debt position, or CDP stablecoins, and decentralized exchanges, or DEXs. As the name suggests, lending apps let users borrow crypto by locking up crypto as collateral, with the loan's terms set by the app's risk models. Collateral debt position stablecoins are over-collateralized with crypto, like DeFi loans, but instead of borrowing crypto, you mint a synthetic USD-pegged token against your collateral. And most of you will already be familiar with DEXs such as Uniswap, Radium, and PancakeSwap, to name just a few. Some DEXs allow users to use leverage to take on additional risk and amplify their positions. And by the way, if you're looking to maximize your own trading experience, then you have to check out the Coin Bureau deals page. There you'll find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and deposit cashbacks of up to 75% on crypto exchanges. These deals won't be around forever, so take advantage while you can using the link below. Okay, now that we're familiar with the basics of lending services, the report moves on to the state of the lending market in both CeFi and DeFi, which was shaken to its core after a series of black swan events in 2022. Events that sent us deep into the depths of a crypto bear market. For perspective, the report highlights that from the 2022 peak to the bear market low, CeFi and DeFi lending shrank by about 78%, with CeFi losing 82% of open borrows. Big names like Voyager, Celsius, BlockFi, Genesis, and Silvergate were major casualties, all of which went under. In any case, the report reveals that crypto lending only took off around late 2019 to early 2020, despite some players launching way back in 2012. The real boost came after Ethereum launched in 2015, bringing smart contracts that made DeFi possible. So, what exactly went wrong in 2022? Well, those of you who've been around for a while will still probably be discussing it all with your therapists. For everyone else, a few notable events kick-started a rocky 18-month period for the lending market and indeed the broader crypto market too. These included the collapse of Terra's UST stablecoin and Luna token in May 2022, the depegging of Lido's staked ETH token less than a week later, the liquidation of Three Arrows Capital in July 2022, and of course the spectacular collapse of FTX in November 2022, the world's second largest crypto exchange at the time. The implosion of FTX and Alameda Research then caused the subsequent collapses of BlockFi in November 2022, Genesis in January 2023, and Celsius in July 2023. Thanks a lot, Sam. Don't drop the soap, will you? Galaxy estimates that at its peak, CeFi lending reached $34.8 billion, but dropped 82% to $6.4 billion in the bear market. By Q4 of 2024, it had recovered 73% to $11.2 billion, though it's still 68% below its all-time high. Good progress, but a long road ahead. In 2022, 76% of the $34.8 billion CeFi market was held by just 3 lenders: Genesis, BlockFi, and Celsius. Today, Tether, Galaxy, and Ledn dominate with 89% of market share. The chart provided shows that Tether takes the lion's share, accounting for over 70% of activity, while Galaxy, Ledn, and Coinbase have roughly equal market share. Next, the report looks at the combined borrowing activity of CeFi and DeFi protocols. Notably, DeFi borrowing hit a low of $1.8 billion during the bear market, but surged 959% to $19.1 billion by the end of 2024. Impressive stuff. The report notes that this is across 20 lending applications on 12 different blockchains, although annoyingly it doesn't explain which applications or which blockchains. It would have been nice to compare these, just saying. Anywho, the report explains that by Q4 2024, on-chain loans were 18% higher than the $16.2 billion peak of the previous bull market. Notably, DeFi rebounded much faster than CeFi, thanks to its permissionless nature and the fact that most DeFi protocols continued to function and didn't go bankrupt, unlike their CeFi counterparts. In Q4 2021, crypto lending hit $48.4 billion, excluding the market cap of collateral debt position or CDP stablecoins. A year later, it dropped 80% to $9.6 billion, and by the end of 2024, it had recovered to $30.2 billion, marking a 214% growth. What's intriguing is that despite the collapse of major CeFi projects from May 2022 to July 2023, DeFi didn't lead the lending market until Q1 2024. By the end of 2024, DeFi lending, excluding CDP stablecoins, was almost double that of CeFi, holding 63% of the crypto lending market. When you include CDP stablecoins, the crypto lending market peaked at $64.4 billion in Q4 2021. By the bear market bottom in Q3 2023, it had dropped 78% to $14.2 billion, but then rebounded by 157% to $36.5 billion by the end of 2024. The report then highlights a noticeable trend. Essentially, DeFi lending and CDP stablecoins have grown steadily since Q4 2022. However, CDP stablecoins have actually lost dominance as DeFi lending terms improved, stablecoin liquidity increased, and things like delta-neutral stablecoins, such as Athena's USDE, have emerged. Then, the report looks at venture investment and crypto lending. Between Q1 2022 and Q4 2024, CeFi and DeFi lending platforms raised $1.63 billion across 89 deals. Q2 of 2022 marked the peak of funding at $502 million, while Q4 of 2023 marked the low at just $2.2 million. Of all the venture capital invested in the broader crypto market, VC allocations to crypto lending apps made up only 2.8% of total VC investment from Q1 2022 to Q4 2024. The highest share was 9.75% in late 2022, but by the end of 2024, it had dropped to just 0.62%. Ouch.
Okay folks, very sorry to interrupt, but I quickly want to tell you about the Coin Bureau merch store. Now, if you love Coin Bureau and you don't just want to watch it, but you want to wear it and just have it in your life, then the Coin Bureau merch store is the place to go. There's a link down below. We've got so much stuff. We've got towels, we've got t-shirts, we've got socks. Give me more shirts, more shirts. We've got so many t-shirts here. We've got bottles, we've got mugs, we've got socks, we've got this hat, we've got these mouse mats. That owl is not for sale. You can't have that. Everything else is in there. Just get the link below. Do it now!
Next, the report explores what went wrong between 2022 and early 2023 and the long-term impact on lending. To refresh your memory, major crypto lenders like BlockFi, Celsius, Genesis, and Voyager went bankrupt during this period. What's crazy is that at their peaks, these four companies made up 40% of the entire crypto lending market and 82% of CeFi lending. However, when the market shifted from bull to bear, their poor risk management and acceptance of toxic collateral were exposed. The report highlights that this was revealed after crypto topped out and asset prices began to plummet. Specifically, the total market cap of crypto, excluding BTC, USDT, and USDC, dropped by 77%, losing $1.3 trillion. This took the market cap from $1.7 trillion to $399 billion in just 406 days, during which lenders watched in horror as Terra's $18.7 billion UST stablecoin and $39 billion Luna token collapsed. This made any collateral tied to these tokens worthless, with lenders struggling to offload these assets as liquidity dried up. The market downturn also caused issues for both Grayscale's Bitcoin Trust, which later became a spot Bitcoin ETF, and Lido's staked ETH token. The problem was that investors couldn't withdraw the underlying assets, BTC for Grayscale and ETH for Lido. For Lido, the Ethereum beacon chain hadn't enabled staked ETH withdrawals, while Grayscale's trust structure prevented instant BTC withdrawals. As a result, liquidity for STETH and Grayscale's GBTC dried up, leading to heavy sell pressure on the underlying assets. As such, GBTC, which had traded at a premium for years, began trading at a discount of almost 50% relative to BTC. Meanwhile, STETH depegged, trading at a 6.25% discount to ETH's value. Elsewhere, a similar issue happened with Bitcoin miners, who often use ASICs, the hardware used to mine Bitcoin, as collateral for loans. Since ASIC values depend on BTC's price, this collateral quickly lost value. Additionally, mining rigs are hard to sell, which contributed to even greater losses. The report then examines the hash price for Bitcoin miners, which measures the daily revenue per unit of mining power before costs. It's typically expressed in dollars per terahash, 1 trillion hashes per second, or dollars per petahash, 1 quadrillion hashes per second. These represent the number of guesses an ASIC machine makes each second to solve a block's puzzle and earn BTC. Anyhow, the chart provided shows the evolution of Bitcoin's hash price and network difficulty over the last 5 years. Notably, when BTC peaked at around $67,600, the hash price was $403 per petahash per second, with a network difficulty of about 21.7 trillion hashes. Over the following 13 months, BTC's price dropped 75% to $16,600, while network difficulty rose by 58%, leading to an 86% decline in hash price. This sharp drop relative to BTC's price was mainly due to rising mining difficulty, intensifying competition among miners, and reducing the BTC earned per unit of hash power. Now, ultimately, this drove down the values of ASICs, but what's crazy is just how much of an impact it actually had. Between Bitcoin's previous cycle high in 2021 and the bear market bottom in December 2022, individual ASIC machines lost between 85% and 91% of their value. To make matters worse, newer, more efficient ASICs made older rigs less competitive and less valuable. As such, the ASIC collateral backing loans taken out by miners lost over 90% in value. Okay, now the next part of the report looks at the positive developments in the lending market since the deleveraging in 2022 and 2023. In the aftermath of the bear market, the industry began to self-regulate with tighter risk management and more thorough due diligence. Perhaps more importantly, though, lenders have taken steps to vet their borrowers, making sure they're solvent and won't get liquidated. This means not offering unsecured or under-collateralized loans, which was a huge problem beforehand. According to the report, quote, Celsius had up to 36.6% of its institutional loan book occupied by unsecured borrowers, and BlockFi lent unsecured to FTX. The report then highlights things to watch in the near future. For CeFi lending, these include banks and institutions entering the space, improving capital access and liquidity while lowering costs. And this shift has been supported by regulatory changes, namely the SEC repealing SAB 121, meaning banks can offer crypto services again, including lending. Bitcoin ETPs have also created opportunities for lending, with ETPs serving as collateral. Meanwhile, the report notes that the future of on-chain credit lies in the tokenization of debt, bringing more utility, transparency, and automation. It also improves risk management, lowers costs, and could be used as collateral or to mint CDP stablecoins, expanding their role in DeFi. And speaking of which, Galaxy says that the future of DeFi lending hinges on more institutions and off-chain firms using its tech as they get more comfortable with the blockchain, see the benefits of going on-chain, and gain clearer regulatory guidance. At the same time, more centralized firms are moving their private credit and business operations on-chain. Moving on, and the next part of the report looks at historical trends in on-chain and off-chain lending activity. Notably, lending is DeFi's top sector, led by Ethereum. As of the 31st of March 2025, almost $40 billion was deposited across 12 EVM-compatible Layer 1 and Layer 2 chains, although, again, it doesn't say which ones. In contrast, Solana holds just $3 billion in deposits. On Aave, Ethereum's largest lender, the main collateral types are wrapped BTC, ETH, and ETH liquid staking tokens, or LSTs. There's $13.5 billion in collateral when combined as of the end of March, with $8.9 billion actively borrowed against it. This gives an average loan-to-value, or LTV, ratio of 65.9%. Total borrows across all 13 chains, including the $1.1 billion on Solana, hit $15.3 billion by the 31st of March, with a 41.45% utilization rate. Aave alone accounts for 58% of that at $8.9 billion. Moreover, open borrows hit an all-time high of $20 billion in January 2022 across the 12 EVM chains, whatever chains those were. ETH and stablecoins are Aave's most borrowed assets. Many investors will deposit crypto as collateral for extra liquidity for additional trades, and borrowing ETH against liquid restaked ETH lets users leverage their ETH positions. Users also utilize the native staking yield built into LSTs to cover some of the loan's costs for additional ETH. And next, the report covers weighted borrow rates for Bitcoin. Notably, wrapped BTC has maintained low borrowing costs since it's mostly used as collateral, meaning there's far less borrowing demand compared to plain old BTC. However, BTC isn't compatible with smart contract blockchains, hence the wrapped ERC20 versions that can be used on EVM chains. As for ETH and ETH LSTs, the chart provided shows that ETH borrowing rates are much higher than the liquid staked versions. Specifically, borrowing rates for ETH LSTs are around 0.5%, whereas it's roughly 2.5% for ETH. This difference is caused by variations in interest rates and how much assets are used across lending platforms. Generally speaking, unstaked ETH is heavily borrowed, while ETH LSTs are used primarily as collateral. By using these staked tokens, users can secure ETH loans at a lower, sometimes negative, borrowing rate. Many will then loop this strategy, borrowing ETH, staking it, and repeating to boost their exposure to ETH staking yields. The report then notes that stablecoin rates, both on-chain and off-chain, track crypto market trends and demand for leverage. On-chain rates are more volatile, spiking up to 15%, while OTC rates range between 7% and 10%. USDC and USDT have similar OTC rates, but on-chain, their rates differ due to varied use cases and risk profiles. As for BTC rates, there's a clear divergence between on-chain and OTC markets. OTC demand comes from shorting BTC and using it as loan collateral. For example, after FTX collapsed in 2022, OTC rates for BTC spiked from an increase in shorting demand. Likewise, in February 2024, they rose again as firms borrowed BTC for stablecoin or cash loans at the start of the bull market. Off-chain ETH rates are stable, driven by ETH staking yield. On-chain rates stay close to this level as lenders prefer lending below the staking rate, while borrowers lack incentives to borrow ETH due to limited yield opportunities. OTC ETH rates follow a similar but milder pattern to BTC. Shorting drives demand in bear markets and collateral use rises in bull markets. Still, firms prefer staking ETH over using it as loan collateral in OTC deals. And finally, we have CDP stablecoins, which had a combined supply of $9.6 billion by the end of March. Sky's USDS, formerly DAI, had the lion's share of this with $8.7 billion in supply. However, the report adds that despite stablecoin supply being near all-time highs, CDP stablecoins are still 46% below their peak of $17.6 billion in January 2022. Notably, CDP stablecoins' share of the stablecoin market fell from 10.3% to 4.1% by the 31st of March due to the rise of USDT, yield-bearing stablecoins like USDE, and weaker demand for CDP stablecoins as on-chain dollar liquidity. Their market cap dropped 55% from $17.3 billion in January 2022 to $7.9 billion by March, mirroring the decline in open borrows on lending apps. And that brings us to the end of this report. Well, sort of. There's actually another 12 pages, but honestly, the back end of the report just explains various aspects of the lending market in extreme detail, including specific code that various protocols use to determine borrowing rates. But hey, if that's your thing, then by all means, the full report is in the description below. Go nuts. For now, though, there's just one question remaining. What does all of this mean for the crypto market? Well, it's clear that the lending market is recovering well since SBF blew crypto all the way to hell. There's still a way to go yet, but so far, so good. This sector will likely benefit as the bull market continues. That's because investors will want to borrow against the BTC, ETH, and other large cryptos they have to invest in other cryptos, mostly altcoins. In turn, this will also help pump the prices of these altcoins. What's more is that the regulatory backdrop, which continues to improve, suggests that the lending sector will be bigger than ever. That's because institutional investors will have much more confidence in exploring some of crypto's more nuanced corners, including DeFi. The downside, if indeed you can call it that, is that it appears VCs aren't remotely interested in lending, given that less than 1% of venture capital finds its way into the lending market. Again, though, this could change with the improved regulatory backdrop. From our perspective, crypto lending will grow in a big way as the tokenized real-world asset sector, or tokenized RWAs, gains traction. That's because institutions are desperate to leverage DeFi to find new ways to generate a yield on assets that were previously off-chain. And of course, more lending means more demand for crypto. So this is definitely something you should be keeping a very close eye on. Now, if you enjoyed that video, smash those like and subscribe buttons and turn on those notifications too so you don't miss our next one. If you want to see what catalysts could drive the crypto bull run, then check out this video right over here. And if you want to learn more about how institutions are trading OTC, then you can find out by checking out this video right over here. Thank you all for watching, and we'll see you in the next one. This is Guy, signing off.